It happens every year between February and April. Millions of American seniors sit down at their kitchen tables, surrounded by stacks of receipts, 1099 forms, and Social Security statements. They are doing their civic duty, filing their taxes just as they have for decades. They trust the system. They trust the forms. They trust that if there is a tax break available to them, the IRS or their software will automatically apply it. But that trust is misplaced. Right now, hidden in the dense pages of the U.S. tax code, there are provisions worth thousands of dollars specifically designed for people over the age of 65 that are going unclaimed by the very people who need them most. We are not talking about pennies here. We are talking about a combined tax benefit package that can be worth up to $12,000 or more in reduced tax liability and protected income. And the tragedy is that the overwhelming majority of eligible seniors either don't know these rules exist or they assume they don't qualify because their income is too high or too low. They file their returns, pay more than they legally owe, and leave money on the table that could have paid for groceries, medication, or utilities for months. This is not a new government stimulus check that requires an application. This is not a lottery. This is your money. It is money that the law says you should keep, but only if you know exactly which boxes to check and which lines to fill out. The IRS has confirmed these provisions for the 2024 tax year, and the numbers have been adjusted in your favor. But if you don't know about them, you can't claim them. Welcome back to Senior Security Update. I am your host, Zane. Today we are going to do something different. We are going to demystify the tax code for seniors. We are going to break down, step by step, the three major pillars of tax relief for Americans over 65. We will explain the super standard deduction that is now available, how you can legally stop paying taxes on your Social Security benefits even if you have other income, and the mysterious Schedule R credit that millions of seniors qualify for but almost no one claims. By the end of this video, you will have a roadmap to potentially saving thousands of dollars on your next return, or even amending your last one to get a refund you didn't know you were owed. Let's start by setting the stage. The tax code is a labyrinth. It is over 70,000 pages long. It is designed to be confusing, but within that confusion, there are specific carve-outs that Congress has created to help older Americans keep more of their fixed income. The problem is that tax preparation, whether it is done by a human or a computer, is often a rush job. Preparers are trying to get through as many returns as possible during tax season. Software is designed to ask the most common questions, not the most specific ones. This means that unless you advocate for yourself, unless you know what to look for, the default setting is often the one that costs you money. Today, we are going to change that. We are going to empower you with information. We are going to walk through this in 5 clear sections. First, the enhanced standard deduction. Second, the Social Security tax shield. Third, the elderly and disabled tax credit. Fourth, the action plan for what you need to do right now. And fifth, we will debunk the myths that scare seniors away from claiming these benefits. Let's dive into Section 1, the enhanced standard deduction. Most people know what the standard deduction is. It is the flat amount of income the IRS lets you earn tax-free before you start paying a single dime to the federal government. For decades, the advice was, itemize your deductions. You would list your mortgage interest, your state taxes, your charitable donations, and your medical expenses. If that total was higher than the standard deduction, you itemized. But the Tax Cuts and Jobs Act of 2017 fundamentally changed the math. It nearly doubled the standard deduction, making itemizing unnecessary for about 90% of taxpayers. However, here is the secret sauce for seniors. The standard deduction is not a one-size-fits-all number. There is a base number, and then there is a bonus number specifically for age. For the 2024 tax year, which is the return you will file in early 2025, the base standard deduction for a single filer is $14,600. That is already a healthy number. But if you are 65 or older by the end of the year, the IRS adds an additional standard deduction of $1,950 on top of that. This brings your total tax-free income threshold to $16,550, Now, let's look at married couples because the numbers get even bigger. The base standard deduction for a married couple filing jointly is $29,200. But if one spouse is 65 or older, you add $1,550. If both spouses are 65 or older, you add another $1,550. That means a senior couple, both over 65, gets a standard deduction of $32,300. That is over $32,000 of income that you can earn before the IRS can touch a penny of it for income tax purposes. Why does this matter so much? Because it lowers your taxable income. Your tax bracket, whether you are paying 10%, 12%, or 22%, is applied to your taxable income, not your total income. By raising the floor of what is taxable, the enhanced standard deduction directly reduces your bill. For a couple in the 12% bracket, that extra $3,100 of deduction for being over 65 saves them almost $400 in actual cash tax liability immediately. That is $400 that stays in your pocket just for checking a box that says you are over 65. But the power of this deduction goes far beyond the direct savings. It acts as a lever that influences other parts of your tax return, specifically the taxation of your Social Security benefits. This brings us to Section 2, the Social Security Tax Shield. This is the most misunderstood area of retirement finance. There is a persistent myth that Social Security income is always tax-free, or conversely, that it is always taxed like wages. Neither is true. The reality is a sliding scale based on something called combined income. This is a unique IRS formula. To find your combined income, you take your adjusted gross income, AGI, which includes wages, pensions, interest, and dividends. Add any non-taxable interest, like from municipal bonds, and then add exactly 1/2, 50% of your Social Security benefits. If that total number is below $25,000 for a single filer, your Social Security benefits are 100% tax-free. You pay zero federal tax on them. If your combined income is between $25,000 and $34,000, up to 50% of your benefits can be taxed. And if it is over $34,000, up to 85% of your benefits are taxable. For married couples, the thresholds are $32,000 and $44,000. Here is the strategic connection. The enhanced standard deduction we just talked about helps you manipulate this formula in your favor. By reducing your taxable income from other sources, like IRA withdrawals or pensions, you can effectively lower the floor of your total tax liability. While the standard deduction doesn't directly change the combined income calculation, which is based on gross income, it provides a massive buffer against the tax that would be owed on the portion of Social Security that becomes taxable. Let's say you are a single senior with $20,000 in Social Security and $15,000 in IRA withdrawals. Your combined income puts you in the range where some Social Security is taxable. However, because your standard deduction is now $16,550, it wipes out the tax liability on the IRA withdrawals and the taxable portion of the Social Security. The result? You pay zero federal tax. Without that extra age-based deduction, you might have owed a few $100s. This is how the benefit stacks up. It isn't just one rule. It is the interaction of multiple rules working in harmony to protect your money. Now let's move to Section 3, the credit for the elderly or the disabled. This is the ghost benefit. It has been in the tax code for years, sitting on Schedule R, yet almost no one talks about it. Tax credits are better than deductions. A deduction lowers the income you are taxed on. A credit lowers the tax bill itself, dollar for dollar. A $100 credit is worth $100 cash. Schedule R is designed for taxpayers aged 65 and older who have low to moderate income. To qualify, you must be 65 or older by the end of the tax year, or under 65 and retired on permanent and total disability. The income limits are strict, but millions of seniors fall within them. For a single filer, your adjusted gross income, AGI, must be less than $17,500, and the non-taxable part of your Social Security must be less than $5,000. For a married couple where both are over 65, the AGI limit is $25,000 and the non-taxable Social Security limit is $7,500. If you qualify, the credit can be worth between $3,650 and $7,500 depending on your filing status. Now, in practice, the formula on Schedule R often reduces this amount based on your actual income, so you might not get the full $7,500. But getting a credit of $500 or $1,000 is still a massive win. The problem is that Schedule R is complicated. It requires a separate form. It requires math that scares people. Many volunteer tax preparers or basic software packages skip it because they assume if you have Social Security, you make too much. But if you have a mix of income sources, or if your Social Security benefit is modest, you might be leaving this credit on the table. It is worth checking every single year. So, who are the people who need to pay the most attention to this? It is the middle class of seniors. If you are very low income, you likely don't pay taxes anyway. If you are very high income, these limits phase out. But if you are in that middle zone, living on Social Security plus a small pension, or Social Security plus some savings, you are in the sweet spot where these strategies can save you thousands. We are talking about single filers with total income between $15,000 and $40,000 and couples between $25,000 and $70,000. This demographic often pays taxes they don't need to because they don't optimize their return. Now let's talk about the action plan. What should you do with this information right now? Step 1. The look back. Go find your 2023 tax return, the one you filed in early 2024. Look at line 12 on Form 1040. This is the standard deduction line. If you are single and over 65, that number should have been higher than the standard amount. If it wasn't, you overpaid. Look for Schedule R in your paperwork. If it isn't there, and your income is in the range we discussed, you need to ask why. The IRS allows you to file an amended return, Form 1040X, for up to 3 years after the original filing date. If you missed the extra standard deduction for the last 3 years, you could be owed a refund check for over $1,000 right now. Step 2. The pre-flight check for 2024. As you prepare for the next tax season, do not just hand your shoebox of receipts to a preparer and walk away. You need to be an active participant. Write a note on the front of your folder. I am over 65. Please ensure the additional standard deduction is applied. Please evaluate eligibility for Schedule R. If you use software like TurboTax or H&R Block, make sure you enter your birth date correctly at the very beginning. The software uses that date to trigger the age-based questions. If you skip that or make a typo, the software treats you like a 30-year-old and hides the senior benefits. Step 3. The withholding adjustment. If you discover that you are going to owe 0 taxes because of these benefits, you should look at your withholding. Are you having taxes taken out of your pension or IRA withdrawals unnecessarily? Giving the IRS an interest-free loan all year isn't a good strategy when inflation is high. You can adjust your W-4P for pensions or W-4V for government payments to reduce or eliminate withholding, putting that cash back into your monthly budget where it belongs. Step 4. State-level opportunities. Everything we have discussed so far is federal, but many states have their own versions of these benefits that are even more generous. Some states, like Georgia, Michigan, and Colorado, have massive income exclusions for retirement income. Others freeze property taxes for seniors. When you are looking at your federal return, make sure you are also optimizing your state return. The senior homestead exemption in many states can save you thousands on property taxes, but it requires a separate application that often isn't part of the income tax form. You have to go to your county assessor's office to file it. Don't miss that. Now, I want to address the myths. Misinformation is the enemy of financial security. Myth number 1. I don't need to file taxes because I'm on Social Security. This is dangerous. While you might not owe taxes, filing a return can be the trigger for receiving other benefits, such as state tax refunds or future stimulus payments. Also, filing a return starts the statute of limitations clock. If you never file, the IRS can theoretically audit you forever. Filing closes the book on that year. Myth number 2. Social Security is never taxed. We covered this, but it bears repeating. It is taxed if you have other income. Ignoring this can lead to a surprise bill and penalties. The IRS is getting much better at matching 1099s from banks with SSA 1099s. They know what you made. Don't hide it. Myth number 3. I have to itemize to get the senior deduction. False. The enhanced standard deduction is a standard deduction. You do not need to list your medical expenses or charitable gifts to get it. It is automatic based on age. In fact, for many seniors, trying to itemize is a waste of time because the new standard limits are so high. Myth number 4. The Schedule R credit is only for disabled people. False. The full name is Credit for the Elderly or the Disabled. The "or" is crucial. If you are 65 plus, you qualify based on age alone, provided your income meets the test. You do not need to prove disability. Myth number 5. My tax guy knows all this. Maybe, but maybe not. Tax preparers are human. They are overworked. They are dealing with thousands of changing rules. If you don't ask, they might miss it. It is your money, not theirs. You have to be the captain of your own ship. Let's talk about the future. These numbers, the $14,600, the $19,050, are indexed for inflation. That means they will likely go up again for the 2025 tax year. The IRS usually announces these adjustments in the fall. We will bring you those numbers as soon as they are released. This creates a compounding benefit. As inflation drives up the cost of living, the tax code is slowly expanding the tax-free zone for seniors. By staying informed, you can ensure that your fixed income keeps pace with these changes. There is also a legislative angle. There are currently proposals in Congress to eliminate federal taxes on Social Security entirely. The You Earned It, You Keep It Act is one such bill. While these have not passed yet, the political pressure to help seniors is growing. We track these bills closely here on Senior Security Update. If the law changes to make Social Security 100% tax-free, regardless of income, that would be the biggest financial win for seniors in 40 years. We will let you know if that happens. In conclusion, the tax code is not just a list of rules about how much you have to pay. It is also a list of rules about how much you are allowed to keep. For seniors, those rules are surprisingly generous, but they require participation. They require awareness. The difference between a stressful retirement and a comfortable one often comes down to efficiency, keeping the money you have already earned. The $12,000 benefit we talked about isn't a single check. It is the cumulative value of the enhanced standard deduction, the tax-free portion of Social Security, and the Schedule R credit. It is real money, it is legal money, and it is yours for the taking. Take a look at your records this week. Pull out that last tax return. Look at line 12. If you see a number that looks like the standard amount for a 30-year-old, you have work to do. Call your preparer, download Form 1040X, fix it, and going forward, approach tax season not with dread, but with the confidence of someone who knows the playbook. I am Zane, and this is Senior Security Update. Our goal is to protect your financial future by giving you the facts that others overlook. If this deep dive helped you, please share it with a friend or family member. Knowledge is the only wealth that grows when you share it. Stay vigilant, stay informed, and I will see you in the next update.